All right. Here to weigh in is an old and very dear friend, Ken Polcari, Kace Capital Advisors, managing partner, one of the best guys in the business. So we didn't exactly get quite the bear market. We wouldn't bear. I wanted to ask you, though, I mean, you're in this market. To me, the worrisome thing, the most worrisome, these individual sectors, what I call look under the hood,
right,
are all pointing, negative, recession, inflationary. What you think?
And they have been pointing that way, and I think they're exactly right. And I think the recession is coming, no matter what they say. I think it's coming. I think it's coming, this summer into the early fall, which is a move for me. I thought it was coming, late winter, maybe into early next year, but I actually think it's going to happen much sooner, right? And I think that's what the market's telling you.
Why is that, Kenny? Just tell me right there. It's an important call. And I think the stock and all these economic sensitive indexes are supporting your view. But tell me
well, listen, we already got a negative print in GDP in the first quarter, right? And it was fairly negative, down 1.4%. I don't see there's any way that they're going to be able to revise that 2 and 3 times and come up with a positive number. They're not. And I suspect that the second quarter is going to do the same thing in July. And once you get to
another negative.
Another negative.
Really?
And once you get two negative quarters, you officially have the recession. But beyond that, I think there are a lot of people that think we're currently in a recession, or at least they feel like their lives are currently in a recession. And I think that the action today, look, we kissed the bear market on the S&P,
right,
and then ended up just closing, just under it, right? But I think that that's kind of the theme, right? We're going to continue to grind lower. I don't think we're going to have this. I don't think we're going to have this massive crash, but I think we are going to continue to grind lower. All those sectors that you pointed out, they're already down 35, 40%, right? And so on some level, those are some bargains out there.
I don't want to quibble. We have Kevin Hassett coming up, who's a terrific macroeconomist and great friend. I mean, manufacturing is rising.
Right.
The jobs market is still pretty good. Now, there are cracks. The housing market looks lousy.
Right.
Retailing looked good, but not after inflation. So, I think there are debating points on both sides. The stock market, no one knows for sure, but the stock market could be forecasting 6 to 9 months ahead.
And it usually does, right? It's a discounting mechanism, so it does look out at least 6 months. So I'd say more like 4 to 6 months versus 6 to 9.
Okay.
But and I think what it's telling you is get ready, right? And look, it's really a math problem because it doesn't know what the Fed's going to do. It doesn't know whether inflation's going to cool down or continue to remain elevated, right? And valuations are all going to depend on inflation, what the Fed does, what interest rates are, and until there's more clarity on that, right? Is 50 basis points realistic, or could it be 75, or even, as you and I once discussed, a full percentage point increase? Is that what we're going to need?
Shock and awe.
Shock and awe, absolutely.
Inflation is worse than people think. Wall Street always wants to paint, sugarcoat this. Inflation's peaking and it's going to come down.
Right.
I don't see any evidence of that. Let me ask some. Jim Bullard, smart guy, my kind of guy, okay? He's a hard money guy. He says the funds rate should get to 3.5% by year end, which would be exactly the shock and awe I want. Now, if that were the case, Ken Polcari, and this is a serious question, if the Fed were that much aggressive, that would be like 75 basis points. What does that do to market rates, 5 to 10s and 30s and mortgages, and finally the stock market?
Right. So I think mortgages are going to end up being closer to 6.5 to 7% by the end of the year if that happens.
Yep.
I think we should see the 10-year Treasury up above, probably 3.5, maybe 3.75% by the end of the year if that happens. But I also think that the market actually is discounting that move. Like it's almost saying we want that move. Like the action is telling you that it's expecting them to do it. So quite honestly, if they shock and awe, you might actually see the market bounce a little bit. Because now it's going to say, look, this is what we've been asking for.
Yep.
We've taken valuations down. You've seen the sectors you just highlighted today. So they've taken these sectors down. Maybe there's a little bit more. But I think they're down. And I think the market would actually welcome like a shock and awe move. Profits
are the mother's milk of stocks. Profits, of course, obviously drive the economy. I mean, profits is the bloodstream in the economy. What's your read? We have some very bad numbers on retailers and so forth. Can profits get us through this or not? Because if they don't, Kenny, we are going to have full-fledged recession.
Yeah, there's no doubt.
And you know what? We're going to have full-fledged recession with higher inflation, which is not good.
And so it's going to depend on how deep is that. That's going to be the next question. How deep is that recession going to be? But I think we're going to yet to see, because I don't think numbers have started to come down. I think they're going to start to come down now ahead of the second quarter, right? The second quarter is July. They start mid-July. And so now as we move into June, you're going to have analyst re-analysis, right? They're going to start cutting forecasts cutting estimates, cutting revenue growth, margin pressure, all that stuff. That's where I think you're going to see us go into a little bit more turbulence in the month ahead, which is why I've been saying all along, you get ready because it's coming.
All right, so I don't think you agree with my philosophy on this, but my Jeremy Siegel, Burt Malkiel was a great friend at Princeton years and years ago. I mean, in a way, because I am an optimist. I can't help myself. You know that. Everybody knows that. I am an optimist. I would be gradually a buyer as the market goes down and then hold the thing for as long as I can possibly hold it until my knees don't work and some other things don't work.
Listen, I'm with you on that. And if you are somebody that's in it for the long term, now look, it also depends on where you are on the age scale, right? If you're 75 years old, that might be a different story. But if you're someone 60,
I beg your pardon.
Well, what I mean, if you're 60 years or less and you've got more time, right? You got 20 years, you got 25 years.
Yes.
If I was a 40-year-old now,
I
would be buying this dip absolutely, and I'd be buying it and holding it, not trading it, not looking for trying to time the bottom.
Good for you.
Just buy it and hold it. And in fact, that's what I'm not 40, I'm 60, but that's what I'm doing anyway.
60 is a great number,
60
man.
is a great number.
75 is a really good number, too. I got to tell you that. All right, kids, Kenny Polcari, you're very good. A block. Come on, let's mark A block on the Kudlow. Terrific stuff. See that, folks? Keep hard. It's going to be okay. It may take a little while, a few bumps in the road.